Have you ever been in that painful situation where you had to repay a bonus, or maybe part of your salary, or even Social Security benefits? If you have, you've probably faced that gut punch of realizing you paid taxes on money that you don't even have anymore. It feels completely unfair, right? Well, there's actually a powerful tax rule designed specifically to make you whole. So let's dive into this thing, Section 1341. All right, here's our game plan. We're going to start with why this is even a problem in the first place. I'm calling it the annual accounting trap. Then we'll look at the government's fix, run through the hoops you have to jump through to qualify, compare your two options for getting relief, cover a couple of special cases, and then wrap up with exactly how you can claim what you are owed.
So first things first, why is this even a thing? Well, it all boils down to a fundamental and sometimes frustrating rule of the U.S. tax system.
Just picture this. You land a new job, you get a huge signing bonus, and you pay a ton of tax on it. Then, a year later, things don't work out, and the company claws that entire bonus back. But wait, the government already took its cut, and they're not exactly volunteering to give it back. You're left holding the bag. It's a brutal scenario, but believe it or not, there is a specific fix for it.
The culprit here is something called the annual accounting principle. Think of it like this. The IRS basically takes a photo of your finances at the stroke of midnight on December 31st each year. Whatever income you had in that photo gets taxed for that year, period. What happens next year doesn't matter. Now, this makes things simple and predictable for the government, but it can create these incredibly unfair situations for you, which is exactly why we're talking about this today.
But here's the good news. Thankfully, Congress recognized how messed up this could be, and they actually built a solution right into the tax code. And that solution has a name. Internal Revenue Code Section 1341. It's all built around a legal idea called the claim of right doctrine. All that means is it deals with money you got under the claim that it was all yours, no strings attached, even if it later turned out that wasn't true. This isn't some obscure loophole or secret handshake. It's a tool put there on purpose to fix the exact problem we've been talking about. And this is the part that is so powerful. You got to understand the intent behind this law. It's not just about giving you some of your money back. The entire goal is to hit the rewind button and put you in the exact same financial spot you would have been in if you had never, ever received that income in the first place. It's a total do-over. Okay, so this sounds amazing, right? But you can't just waltz in and claim it. There are some pretty strict gatekeeper rules. Not every repayment qualifies. You have to pass 3 key tests to get through the door. All right, test number 1 is the easiest. It's all about the money. The amount you repaid has to be more than $3,000. And I mean that literally. $3,000 on the dot? Nope, doesn't count. We're talking 3,001 single penny or more. And this leads to what I call the small repayment trap, which is, well, it's just bizarre. That big tax law, the TCJA, put a bunch of deductions on ice. So now, if you pay back, say, $2,999, you get absolutely nothing back from the federal government, 0. But if you repay just $2 more, $3,001, bam, the magic door to Section 1341 swings wide open. It is a really harsh cliff. Okay, so let's lay out all 3 official tests you have to pass. We just covered number 3, the repayment's got to be over $3,000. Now for the other 2. Number 1, back in the day, you had to have included the money on your tax return because, well, it looked like it was yours to keep, no questions asked. And then number 2, and this is the really critical one, in a later year, it had to be officially established that, oops, you actually didn't have a right to that money after all. So what in the world does established mean? It sounds so legal. Well, it just means you were forced to pay it back. You didn't have a choice. If you just feel guilty and decide to voluntarily give some money back, sorry, that's not going to work for this rule. There has to be a real legal obligation, like a clawback clause in your employment contract, an order from a judge, or a demand letter from an agency like Social Security. Okay, let's say you've cleared all 3 hurdles. Congratulations. Now you get to the fun part, figuring out how to actually get your money back. And you have 2 ways to do it, but it's not really a choice. The rule is you have to run the numbers both ways and then pick whichever one gives you the bigger tax benefit. All right, you've got 2 plays you can run. Play number 1 is the deduction. It's simple. You just deduct the amount you repaid from your income on this year's tax return. But, and this is a huge but, it only works if you itemize. Since most people take the standard deduction these days, this method is basically useless for them. Then there's play number 2, the credit. This one is like a tax time machine. You go back to that old tax return and you recalculate it as if you never got the money. The difference in tax, That's your credit. It's a dollar-for-dollar payback on your current return. And as you're about to see, this is almost always the winning play. And this chart makes it crystal clear why the credit is so much better. Let's look at this example. In year 1, you get a $10,000 bonus. Awesome. You're in the 35% tax bracket, so you pay $3,500 in taxes on it. But next year, you have to repay the whole 10 grand, and now you're in a lower 21% tax bracket. If you take a deduction, it only saves you $2,100 in taxes. You're just out $1,400 forever. The government keeps it. But with method 2, the credit, it ignores your current tax rate. It jumps in that time machine, goes back to year 1, finds that $3,500 you overpaid, and gives every single penny back to you as a credit. You're made perfectly whole. It's beautiful. Now, I have to clear something up because this trips up a lot of people, even some tax pros. Remember how that big tax law change in 2017 suspended a whole bunch of itemized deductions? Well, many people think this deduction got axed along with them. It did not. Let me repeat. The Section 1341 deduction is alive and well. Congress specifically protected it. So for all of you who still itemize, Method 1 is absolutely still on the table. So those are the main federal rules. But I want to quickly hit on a couple of really common special cases you might run into, repaying Social Security, and how things are handled in the state of California. For Social Security, it's actually pretty straightforward. You just need to look at your Form SSA 1099. The agency does the math for you. They subtract what you repaid from what you received and put the net number in Box 5. If that number in Box 5 is negative by more than $3,000, ding, 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 you qualify to use the Section 1341 rules we just talked about. If it's negative $3,000 or less, yep, you're back in that trap and you get no extra tax relief. Now, for anyone in California, you've got to hear this because the state does something really unique and really taxpayer-friendly. California has its own version of the credit, but the way you claim it is key. You don't put it with the other credits. Instead, you put it down in the payment section of the tax return. You list it right there with your withholding, like it's tax you already paid. And that is a huge deal because it makes the credit fully refundable. That means even if you owe 0 state tax, California will still cut you a check for the full amount. It's fantastic. Just don't forget, you have to actually write IRC 1341 on the line next to the amount. Okay, we're in the home stretch. You know you qualify, you figured out your best option. Now for the last piece of the puzzle, making sure your claim is absolutely bulletproof in case the IRS decides to take a closer look. Documentation is everything here. You have to assume this might get flagged because it's a big, unusual credit. So you're going to make a file. Call it your Claim of Right file. Inside, you need 3 things. Number 1, a copy of the old tax return from the year you first reported the income. Number 2, solid proof you paid the money back, a canceled check, a pay stub showing the deduction, a wire confirmation. And number 3, the most critical piece, the document that proves you were legally required to pay it back. That's your contract, the court order, your golden ticket. And that really brings it all home. Look, I know these rules are kind of complex, but Section 1341 isn't just another deduction or credit. It's a fundamental shield. It's a matter of basic fairness, designed to protect you from the injustice of paying tax on money you didn't even get to keep. You know, this whole journey through Section 1341 really makes you step back and ask a bigger question. We all know tax law is mind-numbingly complex, but is it always fair? In the end, I think Section 1341 is the perfect example of this constant tug-of-war in our tax system. On one side, you have the government's need for simple, clean, year-by-year rules that are easy to manage, and on the other side, you have the messy reality of an individual's life and the basic human concept of what's right. And what's so great about this little corner of the tax code is that it's a powerful reminder that sometimes, just sometimes, fairness can win.